So, episode 21. So, today, let's continue the recording of transactions related to loans payable. Okay? But if you are new to this channel and this series, please see first the previous episode so that you can understand what is actually going to happen in this video. Okay? The links are on the description below. But if you're updated and you have already seen or watched all the past episodes, then let's get started. So guys, in the past episode, we have had these entries, right? And I told you that these are not the entries in the books that you are maybe reading right now. But I promise you the substance is just the same. Okay? However, I need to let you know about the entries in your intermediate accounting books so that you can compare. Okay? But before we go to that, let's talk about these entries that we made in the past episode. So, guys, focus yourselves in this debit loans payable here. So, this entry right here will only happen if the principal is paid multiple times or in installments. The same with our illustrative problem. But if we are talking about debts in which the principal is paid only once, and normally it's at the end of the maturity term, then expect that the loans payable will be entered as credit. Because in such a case, the payable balance will always grow each year due to interest. Okay? I hope you got that. Anyways, let's have the entries featured in most of your books. So let's have the entry at the beginning of year 1. So, instead of this entry right here, the alternative entry is debit cash 5 million and then credit loans payable at 5 million. But since you only received 4,657,835 because of transaction costs, you need to get those transaction costs, which is the difference of this 5 million minus 4,657,835, which is 342,165. So you can check that on your own. And let's make an entry, which is credit cash, 342,165. And the debit is, what is it? It's the account discount on loans payable. Okay, that's right. The set of entries that we're going to talk about now in this episode will maintain a discount balance by maintaining this account. Now, you don't need to worry because this set of entries and this set are substantially the same. Like if you're asked, how much is cash? The cash is 5 million here, minus the credit of 342,165 here. It will still equal to 4,657,835, which is the same with the entry here. And if you will be asked about the balance of the loans payable in the financial statements, then 5 million minus this discount on loans payable here, because this account is actually a contra liability account. So it will also result to this credit loans payable here, which is 4,657,835. So again, the substance of these two different entries is just the same. Okay? Now, let's go to the end of year 1. So instead of this entry here, you have to make two sets of entries. So set 1 is for the interest. So debit interest expense, which is just the same with the entry here. So the amount is just the same. And then credit cash for interest payment only. Again, interest payment only. So at the end of year 1, the interest paid is only 500,000. So you need to put it here. And please guys, exclude the principal payment of 1 million for the meantime, because we should only focus on the interest payment. Okay? Now, as you noticed, the entry is not balanced, right? The balancing figure, guys, is 105,519. The question is, which account will be charged? So the account that will be charged is the discount on loans payable. Okay? Now, for the second entry. The second entry is for the principal payment, which is simply debit loans payable of 1 million and then credit cash 1 million. It's as simple as that. Now, since you already know this set of entries, actually, these entries are also the entries at the end of year 2 to 5, except for the amounts, of course. But before we go and make the next entries, let's observe everything about these two sets of entries. Okay? 1. This 105,519 credit discount on loans payable here is actually the amount of discount amortized. Okay? So, let's check. So, we have here in the past episodes, we have the discount amortized at 105,519. So, it's true. This credit right here of discount on loans payable is really the discount amortized. Okay? So, in these entries, the interest expense amount is directly found. That's the second observation. And the amortized discount also is directly found. But the effective payment for the principal, like this one here, which is 800,000 plus, is not found. Okay? So both of these entries has their own advantage. So that's the difference. So let's have the entries at the end of year 2 to year 5 after this. So on year 2, again, the entries are debit interest expense, the same with this one. But the amount now is 489,236, which is the same with this one. But credit interest payment of only 400,000. So let's ignore the principal payment of 1 million. And the balancing figure is the discount on loans payable, which is 89,236. So that's the first entry at the end of year 2. Now, for the second set, we have for the payment of principal, debit loans payable account, and credit cash of both 1 million. Now guys, let me tell you one thing again before we proceed. So this second set of entry is just present if we're talking about debts with principal paid in installments, like in our illustrative problem, which is the principal is 5 million but it's paid in 1 million installments each year. But if we're talking about principal, which is paid only once at maturity date, then this will not be present. Okay? You need to remember that. Now, let's have the entries at the end of year 3. Again, debit interest expense, which is the interest amount here. I hope you can still remember how we got that. So, now, the credit is the interest payment of only 300,000, which is again 10% based on the outstanding balance of 3 million principal. So the balancing figure is still credited to discount on loans payable, which is now 70,836. Now, for the principal payment, of course, debit loans payable account of 1 million and then credit cash 1 million. So that's it. Now, on year 4, debit interest expense again, which is 250,045, and then credit cash for interest payment of 200,000. And the balancing figure 50,045 will be credited to discount on loans payable. And for the principal payment, we have debit loans payable and credit cash 1 million. See? It's just repetitive. And for the last year, we still debit interest expense, which is the same with this one, but then again, the amount was the difference of the 1.1 million minus 973,471. So 1.1 million was used instead of this 1,100,022 to make this here 0. Okay? I know you remember that in the past episode. So, the interest expense debit is 126,529, and then credit 100,000 interest payment, and the balancing figure will still be credited again to discount on loans payable, which is 26,529. And then for the principal, debit loans payable, and then credit cash for 1 million. So those are the alternative entries aside from this set. But guys, I want you to be more flexible. So actually guys, you can make these two sets of entries simplified. Like debit interest expense 126,529, and then debit loans payable of 1 million, and then credit cash of 1.1 million, which is already the interest payment plus the principal payment. And the balancing figure is credited to discount on loans payable of 26,529. So there is only one complex entry, right? So you can do that. And actually it's up to you. So this here and this here as well as this here is actually the same. So it's up to you actually. So all I can say, so these three options that you have here are the proofs of the phrase accounting is an art. So just make sure the substance is there. The substance is the same. So that's it for this video. Next is we will talk about presentation related questions and other theories about accounting for loans payable. So if you have learned, please click like, subscribe, and hit the notification bell and select all to be updated on my next videos. Again, thank you for watching and see you on the next one. And remember, study now because I promise you it will be worth it someday.